Have you ever felt like corporate finance is this super complicated thing, you know, just for Wall Street gurus in fancy suits? Well, I'm here to tell you it's not. It's actually a story. It's the story of a business, from that first little spark of an idea all the way to becoming a global powerhouse. And we're going to see how that whole story unfolds just by following the money. So to kick things off, let me ask you this. What could a brand new, scrappy little startup in Silicon Valley possibly have in common with some massive 100-year-old corporation? I mean, they seem like they're from different planets, right? One's just trying to survive, the other's managing a giant empire. Well, here's the secret. It turns out they're both following the exact same playbook. Yep, from how they raise their very first dollar to how they make these huge, company-changing decisions, the core rules are exactly the same. So today, we're going to flip through that playbook chapter by chapter. All right, first things first. Before we dive into all the details, what's the actual point of all this? What's the goal? Because believe it or not, underneath all the jargon and the complicated spreadsheets, every single decision in corporate finance comes down to one simple, powerful idea. It's all about this one thing, creating value. Now, don't let the letters NPV scare you. Net present value is just a fancy way of asking a really simple question. If we spend this money today, is the thing we're creating going to be worth more than what we put in? If the answer is yes, you're creating value. Every single choice is judged by that one simple rule. That's it. That's our North Star for this whole journey. Okay, so every company starts with an idea. But you know what? Ideas are great, but they need money to actually become a reality. And that brings us to the first big chapter in our company's life. How do you get the cash you need to even get started? For a lot of new companies, the journey starts with something called venture capital. You can think of this as fuel for rockets. VCs are investors who are looking for those young, risky companies that have the potential to be huge. They provide that critical first batch of cash that helps turn a plan on a napkin into a real, breathing business. Now, if the company does well and grows, it might hit this huge milestone, the initial public offering, or IPO. This is like the company's big debutante ball. It's its coming out party to the world. It's that moment when it goes from being privately owned by a handful of people to being a public company where literally anyone, you, me, anyone, can buy a small piece of it. All right, so our company made it. It's gone public. It's got a healthy chunk of change in the bank. So what now? Well, now comes the really critical part. How do you use that money to make even more money, to create even more value? It's all about making smart investment decisions. And the absolute gold standard for making those decisions is our old friend, net present value. The big idea here is so powerful. $1 in your hand today is worth more than a promise of $1 next year. So NPV helps us answer that key question. If we invest this money today, will all the cash it's going to generate for us in the future, once you account for time and risk, actually be worth more than what we're spending right now? If the answer is yes, if that NPV number is positive, you go for it. It's a green light. But you gotta be careful, because not all ways of making decisions are created equal. The NPV rule is so great because it looks at the entire life of a project. Now, compare that to this other thing, the payback rule. It's a tempting shortcut, but it's really dangerous. All it asks is, how fast do I get my money back? That's so short-sighted. It's like planting an orchard and only caring about the first few apples, totally ignoring the fact that you could have a massive harvest for years and years to come. See the difference? One is about long-term value, the other is just about a quick win. Okay, let's jump to the next stage. Our company is growing like crazy, and it wants to build a huge new factory. To do that, it needs a ton of cash. And this leads to one of the most fundamental choices any growing company has to make. Should we borrow the money, which is called taking on debt, or should we sell off more little pieces of the company, which is issuing more equity? Now, taking on debt, borrowing money, it has this really interesting, kind of hidden advantage. It's called the interest tax shield. And here's how it works. When a company pays interest on a loan, it gets to count that interest as a business expense, just like paying the electricity bill. And because it's an expense, they get to subtract it from their income before they calculate how much tax they owe. So less income to tax means a smaller tax bill. It's a pretty sweet deal. And this table for, get this, Space Babies Diaper Co. makes it super clear. So look on the left. If the company uses only equity, no debt, it makes $1,000, pays $400 in taxes, and has $600 left for its investors. Simple enough. Now look at the right column. This time, they use some debt. So first, they pay $100 in interest. That drops their taxable income to $900, which means their tax bill is only $360. Now here's the magic. The total amount of cash going out to all investors, shareholders, and the new lenders combined is now $640. That's an extra $40 that basically appeared out of thin air just because they used debt and got that tax break. So far, we've talked a lot about making money and getting returns, but we can't forget about the other side of that coin, and that is risk. Every single financial decision, big or small, is about navigating this constant push and pull between wanting a bigger reward and trying to manage the potential downsides. This right here is one of the iron laws of finance. There is absolutely no such thing as a free lunch. If you want a chance to get those really high returns, you have to be willing to accept more risk, more uncertainty. So the game isn't about avoiding risk altogether. That's impossible. The game is about managing it smartly. And this leads to this really cool idea called the efficient frontier. Just think of this curve as a map of all the best possible choices. For any level of risk you're willing to take, that's what you see along the bottom, this curve shows you the absolute highest possible return you can get for that risk. If you're anywhere below the curve, you're doing it wrong. You're taking on risk and not getting properly paid for it. The goal is to always be right on that curve, on the frontier. All right, let's hit the fast forward button. Our little company is now a huge, mature, stable corporation. The crazy growth from its early days, that's probably in the past. So how does a giant company like this keep creating value? How does it avoid just getting old and slow? Well, it starts making big strategic moves. At this stage of the game, you've got this whole toolkit of major moves. A company might merge with a rival to become bigger and more efficient. It might get bought out in something called a leveraged buyout, or it might even decide to break off a piece of itself and let it become its own new company. Each of these is a massive undertaking designed to do one thing: shake things up to unlock some kind of hidden value. Let's just zoom in on one good reason to do a merger. This idea of economies of scale. Imagine two airlines combine. All of a sudden, their fixed costs, things like their computer systems, their repair shops, can be spread across way more airplanes and way more passengers. That means their cost for each passenger goes down. That savings, that new efficiency, is pure value creation. It's a perfect example of a big decision with a huge positive NPV. So there you have it. We've gone through the entire life of a company, right? From that first risky idea all the way to a mature industry giant. And what we've seen is that there's this consistent set of rules, this unified playbook that guides the financial journey at every single step. And here it is, the whole playbook on one slide. It all starts with a goal: always create value. Then you get the funding you need to get going. You invest that money using smart rules. You figure out the right mix of debt and equity to grow. You always manage your risk. And finally, you keep evolving to stay in the game. It doesn't matter if you're in a garage or on Wall Street, this is the fundamental journey. Which, of course, leaves us with one last big question. If the playbook is really this clear and the rules are this logical, then why do we see giant companies making disastrous financial decisions all the time? Well, that's the thing, isn't it? The principles might be simple, but actually putting them into practice in the real, messy, unpredictable world, now that's the hard part.